right, with that, we're going to go ahead and jump into our first panel. So I'm not going to do an introduction for these two people because given the audience, they're very well known in the industry. Two successful natural gas traders are going to be here to answer your questions. And I'd like to welcome up to the stage Bill Perkins and John Arnold. Let's give them a round of applause.
Thank you.
All right, let's jump right into it. I'm going to be selfish, and I'm going to kick it off with one question that I've always wanted to know the answer to, but I've never had the opportunity to ask it before. I'm just going to say you two are a little bit of an odd couple, okay? You have very different personalities on the surface. Bill, I've had the pleasure of knowing you for a long time. John, unfortunately, I haven't had the pleasure, but I know you through reputation, and I'd like to find out how you two came to know each other. I know, obviously, you hired Bill at Centaurus, but tell me the story.
You've got a better memory than I do on these things, so you start.
I think I got to Houston in '95, and I think natural gas trading is, a lot of people on the outside assume we compete with each other, and that's somewhat true, but it's more like golf. You're competing against the golf course and yourself, and you're trying to do well against the market. It's not like you're directly distracting your fellow golfer. There's no Noonan, or messing them up, and so that created an environment where all the natural gas traders in the industry when we were young we talked shop all the time, we hung out all the time, we gambled about football all the time. We just kind of ran around with each other and obsessed about natural gas in the earlier days. And so I met John when he was at Enron. I don't know, it might have been Fum Ducks or someplace in Houston, a Super Bowl trip or whatever, and we just kind of all hung out together. That was,
Yeah, and I think, the late 80s, early 90s, when this industry was really starting, I think there was kind of this battle about, are the banks going to learn the energy industry, or is the energy industry going to learn trading? And so is this center of the industry New York, or is it center of it in Houston? And I think it kind of started in Houston, then kind of went to New York, and then the banks who didn't really understand the natural gas market but understood trading ended up not having a good run of it broadly. And it started to come back to Houston. And so kind of mid-90s, I came down to Houston, same year, 95. And it was a bunch of 20-something-year-olds who ended up in this industry working for energy companies in Houston that were all kind of like the same things. We were all kind of new to Houston, new to the industry, and just we would compete against each other during the day, but then at night we'd all go run around with each other and talk the industry nonstop.
Interesting. And why do you think that is, that the banks were less successful than the energy companies at figuring out natural gas trading?
I think learning the basics or even kind of intermediate expertise in trading was easier than the financial guys learning intermediate knowledge of the energy industry. And so if you didn't know how pipes worked, especially kind of back then when information was much harder, and if you didn't have that physical operation behind you and the knowledge and expertise all around you as you were trading, I think it was much harder for the banks to succeed. They didn't, the unknown unknowns for them in the industry versus more known unknowns for the energy industry. Like, okay, we know we don't have the trading expertise. Let's hire some 20-something-year-old quant guys, pair them with guys who really know the energy industry, put them together. And that was actually my first trading job at Enron was exactly that. I was a kind of a 55-year-old guy who had been in the natural gas industry forever, didn't know anything about trading, and me, a 21, 22-year-old who didn't know anything about the gas industry, but kind of knew numbers, could kind of figure things out. But two of you sit down here and you guys figure it out.
Yeah, and it used to play out in some of the trades with the banks. A good example is CSOs. I was primarily the guy who got that launched over the counter. It was just an over the counter trade at the time, and the banks had all the models for CSOs. But what they didn't understand is March, April wasn't going to negative 50, right? And so you used to be able to basically buy put spreads are basically the market versus the physical infrastructure versus options, and people didn't understand that. They would be buying 0 puts for 20 cents, right? And there was a time where that just fundamental understanding of the physical market was lacking, right? Like they might outtrade me and have all the CSO models, right, and understand these models better than I could ever, and the math, but they didn't understand the physical underlying commodity that well to realize, like, wait a minute, in essence, correlation goes up as March, April goes to zero. Like it's not going to negative 20, it's capped off.
Yeah.
So,
and you saw this exactly with Amaranth,
yeah,
right? Whenever the risk managers at Amaranth didn't understand gas and were applying their same models that they were using for rates and for equities,
right?
And trying to apply that and not understanding, where the risk along the curve was, and just completely missing what the downside scenario.
That's interesting. So it's a difference of a depth of financial understanding of how these instruments work versus fundamental understanding. And in this scenario, the fundamental understanding won out. But I want to touch on something you kept talking about, which was you keep mentioning people's age. And I've actually thought about this a lot, right? So natural gas trading and trading in general, it has historically been a young man's game. It is maturing, right? And a lot of the traders, who started in the same era that you did are getting a lot older. We haven't seen as much young blood coming in and replacing that. Does that change it at all? Is that necessary? Is there something about being a 20-year-old that makes you more able to take risk or an implicit advantage over the 55-year-olds?
I guess let me answer this two ways. One was, when we came into the industry, I think the last of the deregulation that happened in gas happened in '89, if I'm right. And so, the industry was really nascent at the time when we both got into it. The markets were figuring it out. I think all the market participants were figuring it out. So we coming in as, kind of new people to the industry, Bill had been trading on the floor, but I was, kind of brand new to the industry. We weren't that far behind, right? And I remember like the person whose job I took at Enron, he blew up at Enron, and that's when they put me and this other guy, and you guys go figure this out. He didn't have that much experience either, and so we were all trying to figure this out, and it wasn't, me as a newbie competing with somebody with 20 years experience in the market. And the first time I sat down, I was trading a basis book, and it was right after the basis blew out in that 95, 96 winter. And so come that summer of 96, nobody knew what was going on, what the basis markets looked like, what things should be valued at. And so I think it was pretty easy. Or it's easy because we're all kind of starting from scratch.
Yeah.
Right? And then, going to today, I think psychologically, I think oftentimes trading is a younger person's game. It was for me. There are people who are going to die at their computer trading stocks or natural gas or something. They're going to be 95 years old, and that's their passion, and that's what they want to do. For me, I was in this industry for 17 years, and that's kind of the only thing I had done, and I just kind of hit a wall. I had decided that my business plan was try to be best in the world at this little niche. And so, I had lots of opportunities to try to make that niche bigger, to trade oil, to trade energy equities, to trade, metals, ags. We all thought about that all the time, and I kept going back to, we're just going to focus on North American gas, which kind of means we have to do power as well. That eventually required us to do European gas as the LNG market started to become relevant. But just do this one little thing and try to be best in the world at it. And if so, then it's going to work out pretty well. And the upside is, the financial success followed. The downside is 17 years of just doing this one thing. I got, to be 38 years old. I'm like, I'm just burnt out. I don't have the passion for it anymore. I can't compete with the people who do have the passion.
I can understand that. Do you feel the same way, Bill? Is it a young man's game? And
I do, and I think one of the problems, I think a lot of the people in the shops, that are if you look around, the other shops are generally older people, and I think one of the reasons is that because the banks are not the largest traders per se. I mean, they have the customer business, et cetera, but a lot of risk warehouses are like these hedge funds that started out, and they tend to be medium-sized funds, $300 million to $1.5 billion, not these like giant banks. We don't have these giant training programs to go yank somebody from
that's a good
equity
observation.
derivatives and put them into natural gas. And all right, now stick with these guys and learn it. So I think one of the problems at my shop, which I've talked about openly, is like we're dinosaurs. Like we're going to die out. Like where do we don't have this training program now. Some of us have invested in it. I think Copperwood has done a good job of bringing in young people and putting them through the analyst pool into the trading pool. And some of us have not been as good as that, not having the resources or not being large enough to have that program. And so I think it is a young man's game. I think the raw calculation power, the just not having the risk warehousing of other people. Like they're not worried about their wives and children if they blow up. They're like, it's all natural gas all the time. That ability to focus is great. But I just think that the nature of the industry doesn't have those training programs as much as they would have in interest rate derivatives, right? Like there's a massive training program for interest rate derivatives in banks, right? Because the banks run interest derivatives.
Yeah, and a small fund, obviously you don't have the resources or the incentive to bring up the next generation. So because it's so dominated by these medium-sized funds, we may be running into a crisis, right? Everybody kind of came about in the same era, like the early 2000s, and everybody may want to retire around the same time. And we need the next generation to come into natural gas and take over. I'd love to dive deep on this topic, but we just spent 15 minutes on my first question. I do want to get to some of the other ones. So I'm going to go actually into the fundamentals now, all right? And I'm going to talk about two of the big demand components that are large uncertainties that everybody is trying to quantify and understand. So let's start with AI data center demand. SynMax has played its role in contributing to AI data center demand, as Bill knows. We process 27 million square kilometers of satellite images every single day, which is about 2.5 times the land mass of the entire United States, including Alaska. Every single day we ingest that volume of imagery. We actually ingest more imagery than most countries in the world, even including those with their own satellite constellations. But so yeah, when I call Google Cloud, they pick up on the first ring and they say, "Hey, Eric, how's the family? So good to hear from you." How significant do we think, if we're going out 10 years, is AI data center demand going to be for natural gas? And have we seen something like this before? There's been a lot of predictions of big disruptions coming into the market. Is there an analog that you compare this to?
I mean, I think when you had the natural gas power plant infrastructure build out, when things were 12 REIT, 10 REIT rate, and we had that build out, and those were the days where storage wasn't growing as fast as demand, and you'd have the situation where the market would go into containment, everybody get rich, the risk warehouses on market, going to like $1 or $2, $1.50, and then it looked scary in the winter because there was so much demand, right? And so from, you just didn't overlay supply, demand, and storage at the time. I don't know yet if AI is hit that. I mean, some of the projections are like, oh my God, right? And, there's all this talk about like, as it gets better, it'll get cheaper, but really demand has gone up. And we've seen that with like recent articles just come out. It seems like every 2 days something amazing comes out with multi-agents, right? It's like, oh, they're getting more efficient. And now there's this new things. Instead of just running one big agent, you run multi-agents, but they use 15 to 30 times the more tokens. And so that demand is spiking. And then obviously, SynMax is tracking these. I thought it was hype in the beginning, and then we started digging into it, tracking the AI data centers. It's like, oh, it's greater than a half a B or a B coming on a year. This is real, and you're on the board of Meta now, so you have some, I think, better insights into data center demand and what's happening.
I think the gas-fired gen boom that you saw in the early 2000s, is a great example, right? And that was, ironically, the last time we saw electricity demand growth as a nation. And so electricity demand, advancements in combined cycle technology, and so there was just this massive build out of gas-fired gen that did great, and a bunch of people made a lot of money for a while, and then 2008 hits and electricity demand flattens, and then there was a lot of losses. Everybody who had invested in that equipment, even the manufacturers of the equipment, the GEs of the world, and have all lost a lot of money. And so I think that's the big question, right? And I joined the board of Meta start of 2024, and that year, like every conversation I had with somebody in the tech sector, they wanted to talk about energy, and every conversation I had in the energy sector, they wanted to talk about AI. And so like these two worlds that had been like this couldn't be more different, or all of a sudden we're just united. And what I've seen in the industry was that back 18 months ago, all the hyperscalers were saying, we're going to build out for the upside case in AI. We don't want to fast forward a couple years and be behind our competitors because we didn't invest an extra X billion dollars in data centers. And so they were just like, we don't know what AI is going to be. In fact, there has been and still are, these very vigorous debates, even within AI expert community about what the future looks like and what the need for data centers is. But everybody decided we're not going to get caught behind. So let's go ahead and build for the upside case. And if we end up overbuilding, which we probably will, it's okay because we'll catch up. We'll just stop building for a couple of years. Our demand will catch up and be fine.
That always works out.
What I say is like the upside case that they saw 18 months ago, I think is underdoing or underestimating what they believe the upside case is today. And so seemingly every few weeks you see a hyperscaler come out with plans for even more build out of data centers. There was a lot of talk whenever Microsoft gave up some of its options. What they're actually doing is moving from the very large data centers to more distributed data centers, so going from the gigawatt plus to 100 megawatt, 200 megawatt data centers. Meta is actually doing the opposite, going more towards the big ones. So this is more about how individual companies, how their plans are, what their use case is for the data centers. But the CapEx that's going to it and the build out, you just keep seeing more and more announcements. How that translates into energy demand, I think, is very unclear. You don't know. There's three big efficiency areas that are possible. One is on data center construction, one is on the chips, and one is on the algorithms. And you will see efficiency gains on all three of those. How much and how those play out and the interactions across those, I think, are very unclear at this point. Right? We went through the 2010s with significant growth in data center build out without paired with data center energy demand because of all the efficiency gains that we were seeing in data centers during that time period. That low-hanging fruit kind of got picked by 2020. You stop seeing those efficiency gains. But there's never been more either financial incentive or interest from the hyperscalers to find those gains today. And so how that plays out, I don't know.
That's fascinating. I want to talk about another big component of upcoming demand, which is LNG. In particular, I want to go into the fiasco with Venture Global. So I'm going to use the term allegedly to protect ourselves here since we are recording this. Allegedly, there are those out there who believe that Venture Global is playing a little bit of a game right now with when their terminal is actually ready for their customers to start taking cargoes on it. I want to ask you what you think of this tactic, because if you look at the stock price of Venture Global, it seems like it's actually working, right? So if they are ultimately successful in this, is it going to influence the strategy of other LNG exporters?
My view is it was a convenient incident. So I do believe that they had an issue. I think it fit the definition in their contract of we're not ready, and they financially benefited from this delay, but being in kind of like we're not complete. We're not turning over title to the gas to you because the market went bananas because of the war and all the disruptions overseas. And so I think it was a convenient thing that they're taking advantage of, and I guess the courts will decide, the arbitration of courts decide is like, oh, is this right? Is this the intent? I'm not a lawyer, but four corners of the agreement or the intent of the agreement, I don't know.
It was never let a good crisis go to waste.
Exactly.
Yeah, I'm not sure this affects the gas market at all, and I don't think it affects LNG market prospectively. It was a mess up in contracting, right? The contractual language wasn't good. That's been fixed for all contracts going forward, right? No one's going to make this mistake again. And this is just a fight over money between Venture Global and their customers. And I would be shocked if any customer wants to do a deal with Venture Global again in the future. I think you find businesses that you want to go into partnership with that you can trust to do the right thing and abide by the spirit of the agreement, and those that are going to take advantage of any ambiguity in the wording, and you don't want to deal with those people in the future.
Yeah, you can do that one time. Bill likes to always say you can never paper over trust.
Yeah.
Don't go into, doesn't matter how good the contract is, don't go into business with anybody you can't trust.
Correct.
All right, let's keep this going real quick. So I want to go to the supply side now, which is kind of, where SynMax specializes. So we've got these two big components of demand building out, AI data center, LNG export. All of this has the promise to produce a lot of demand for gas. Now we need the supply component to come in, right? So, I originally said there were three options, right? And John, you wisely pointed out there's actually a fourth option. So where does the new gas come from, okay? Option one, it comes from the Haynesville, right? Haynesville has been the marginal producer of gas for a long time. Option two, we get it from Associated. That's really going to depend on oil economics, but we've definitely had gas coming from there before. Option three, one of these new plays, right? So EOG has Dorado Basin in South Texas, very strategically located. They're making really big claims about break-even prices of around $1.40, which some firms are even saying could be as low as $1.25, right? But we haven't seen a lot of rig and frac crew activity in that area yet, so they're kind of sitting on it. There's also Western Haynesville, or what some people call the Deep Bossier, which Comstock has. I think there's potential to get 3, 4, 5 Bs a day out of that region if they develop it. Or is it going to come from the Marcellus? Is permitting reform going to come in and save the day, and we're finally going to get some pipelines built? Either one of you, start it off.
So maybe I'll start with the Northeast. All right? And so we've plateaued in the Northeast as you haven't been able to build an interstate pipe in this country for many years, with the exception of MVP, which took an act of Congress. There's 5 or 6 different interstate pipes that were started by midstream companies that ended up being 9 to 10 figure losses for those companies because they got tied up in the courts. And this kind of goes back to this broad history of permitting reform, which I'll kind of run through very quickly, like kind of post-war boom, come back, the era of Robert Moses from the mid-40s to about 1970, when a lot of good projects got built, a lot of bad projects got built. Right? And so you had these environmental disasters that really came to fruition in the 1960s, the environmental law response that happened between 1970 and 1973, which included the start of EPA, NEPA, Clean Air Act, Clean Water Act, and Endangered Species Act, that then kind of got rid of the bad projects. And so you went through a couple decades of good projects getting built. Over time, opponents to those projects, whether they were NIMBY or competitors to those projects or labor unions, whatever, who didn't want those projects being built, learned how to weaponize those laws. Courts started taking a much more broad interpretation of those laws. And we've kind of spent this century thus far with the inability to build either good projects or bad projects. Right? And so the question is, this is kind of bipartisan interest in this now, is how do you get back to being able to build good projects? The left has, up until very recently, been very opposed to building new fossil fuel infrastructure in this country. That's starting to change. Connecticut Governor Lamont, recently kind of both publicly but especially behind closed doors has complained about the high prices of electricity, the high prices of natural gas in Connecticut. He can't bring industry there. Voters are getting really mad at this. People hate high energy prices and put pressure on Hochul, governor of New York, to start approving natural gas pipelines up into the Northeast. Hochul, who had her offshore wind project ended by the Trump administration, then cut a deal, we can start building the offshore wind, and we will not object to Constitution pipeline, getting the green light. And then Williams has announced that they are interested in restarting that. I think broader, there's this interest in permitting reform, generally in this country. And it was originally last year was kind of the left wanted to be able to build transmission lines, which I'm involved in separately. The right wanted to build pipelines again, and that was considered the trade. And that came very close to getting across the finish line last year. For some political reasons it didn't, but there's strong political support for doing that. And if so, you can start building interstate pipelines again in this country.
Yeah.
You really need a legislative solution to this rather than EOs that Trump's been doing. And that will allow an outlet for the Northeast gas. It'll also potentially solve, which I assume Bill's going to talk about, this concern about is there a divide between Texas and Louisiana that develops because a lot of the plays, all the plays you talked about, right, are in Texas, and do you start having,
a little bit of a rivalry?
Exactly.
But so John believes that it's going to be the Northeast beast that gets unleashed with new interstate pipelines. Bill, what's your take?
I mean, that'll be interesting. I mean, there's a couple pipelines that are going to come along. Everybody's looking at NG3 and a couple pipelines moving Texas gas out, right? Like everybody's like, okay, we have this giant pool of LNG, but these pipelines, these expansions out of Haynesville and these Texas pipes are coming. I think it's like, I wish I had my a notepad in front of me, like 3 to 6 Bs a day between now and like this Armageddon of LNG facilities coming out. And from the trading standpoint, we're like, is gas going to actually fill these pipes? I don't see the rig counts right now, et cetera, and how's this all going to work out? But, one of the things that, I recently underappreciated is how much gas, especially when there's not that much of a power pull, moves down, going from the northeast down into the southeast, right, with the MVP expansions going on. And so, if you look back, the infrastructure is generally built to move gas to Chicago and to New York. And, we had Rex going this way, going west, out of the northeast, and you have all these little pipes and gas that finds its way through gathering systems, pushing gas south. And so that, started competing with, the Louisiana market. And so I think, we're talking longer term is like, it's hard to compete with gas that's a byproduct. So it's really hard to compete with, Permian gas, right? Like, there's just like, build me a pipe, I'll get,
We'll
this
do
is
it
the
for
bottle.
negative 50
We'll get,
cents.
yeah, exactly. We'll do it for negative 50, negative 20, right? And that being said, the Marcellus is named after a region where you can't even drill yet, right? It's actually in New York, not Pennsylvania. That's the field. And so there's a mass amount of gas, and the liquids there are associated gas. And so I think, in my brain, and this is further out, like I don't think Haynesville competes in the long term if this infrastructure gets built, right? I don't know how it competes.
That's fascinating. I always had a bias not to think it was going to be pipelines just because I hate looking at pipelines, right? Like, it was always the worst part of my job when I was at Skyler, like, just, notices, and it's like you feel like you're just doing mundane grunt work looking at it. But I think you're absolutely right that the big story that maybe not enough people are talking about is, if we get real permitting reform, it solves this LNG problem, but we don't need to look at all these new nascent plays that may or may not actually produce the kind of gas they're talking about.
Yeah.
Well, we're running really low on time, and I want to make sure we're getting to all the questions here. I really apologize, but I want to ask you guys, right? So both of you have proven that you're excellent traders, right? You have that skill set. An excellent trader has a lot of options to monetize that skill set in their career. Both of you made the choice to start hedge funds, however. And in my opinion, when you start a hedge fund, you have to have an additional skill set, which is you have to be able to evaluate other traders, people that are going to sit on the desk with you and work with you and put your assets at risk on your behalf. So first of all, what separates a good trader from a great trader? And when you're interviewing a trader, how do you make that decision that they meet your qualification?
I've always had a hard time answering that question about, what's a good trader versus a great trader versus a bad trader. I've just seen this very wide range of personalities who have succeeded and a wide range of personalities that haven't. I've never got to be good at interviewing traders. The best success I had was seeing people I worked with for years, and over the course of years, seeing how they thought about markets and what their ideas were. and seeing how they manage risk that you can't do whenever it's, got some guy coming in from a different shop that's going to sit here and I'm going to interview him for an hour or two. I just could never extract that same information. And so like people who I knew, who I had worked with, who I like could go out and select and it's like, I want you, I had a lot of success with. People who, had great track records that came in highly recommended from people I trusted, was very difficult. Yeah.
Bill likes to say it's always an HR problem, and I think that speaks exactly to your point, right?
Yeah, I think it's difficult. I think just generally, though, stoicism is, like people ask, why was John so great? What was going on? And it's like he just had this emotional detachment from the results and was very, very hardworking and diligent about the process. And so the results were the results. And, obviously, if they were bad results, they had to be reacted in a certain way, et cetera. But he was very, as much as a human could be, detached. It wasn't like pissed off sometimes or et cetera, but he was very stoic, even in a crisis. And so I think, my blanket answer is that the more stoic you are and the more detached and less emotional you are about trading, you're generally, whatever your baseline aptitude is, you're going to be better, right? And if you're a brilliant professor, know everything, could, wizard around even the best traders, but you don't have that emotional intelligence, you're dead.
Yeah.
You are absolutely dead.
You cannot have an emotional response to it.
Everybody has a plan.
You'll freak out every time you lose, and guess what? Like, I've heard that all traders lose at least some of the time.
Oh yeah, lose some of the times, and those, I think twice Centaurus was in like quote unquote crisis mode. Once intramonth that nobody saw, and it was very much like back to the fundamentals, chopping wood, is this the right risk to have on, et cetera. It wasn't like, oh my God, we're going to lose the fund, and how am I going to look? Am I going to look like an idiot, whatever. It was very much like chopping wood, focusing on the problem, not all these external emotional things. And I think that, my style of trading, or the fund we designed to be a riskier fund, we've been in that scenario where clearinghouses are calling in the morning, and I'm like, okay, this is what I need to do. Let's get out of these risks. Let's take these ICE NYMEX on so we have capital. Let's get these things on. This trade, let's cut out too volatile. This one looks like it's going to pay off. And when it's panic, that, kept us alive to see the 100, 200% returns later in the day.
Yeah.
Had I been a different person, it'd have been over.
Yeah, I mean, that's really fascinating. Maybe it's more about how you handle the losses than actually how you handle the successes, right? Like, if you can't handle your losses in a way where you're rational and your emotions aren't getting in the way, and just say, like, okay, well, this is the situation, right? The weather gods have fucked me again, right? All right, I need to get out of this, I need to do this. This is how we live to trade another day. And then you're there to seize those opportunities.
Yeah.
That's fantastic. I love that answer. That is fantastic. Okay, I have to move right along. So, evolution of the gas market. I want to talk about that. John, you touched on this. Early 90s, right? Deregulation. Both of you guys started your careers right around then. So Bill was 95, John was 96. A lot of people believe this was the Wild West of natural gas trading. Like you talked about, nobody really knew what they were doing, right? And it's a very low information environment, which is subject to gigantic swings. Now, I feel like we are more mature than that, right? There is a lot of knowledge and information built into it. You see it in the Commitment to Traders report. The managed money tends to go one way or another depending on the fundamental views. When was the moment of transition that gas grew up?
Wow. Yeah, I don't know exactly the transition, but I think one of the things is you started having competitors to the shops out there. So you had analysts go out and start these information shops, which made it affordable for the average trader, right, or smaller shops to get some information, right? Like they couldn't build up these big research desks, right? So even just topics that maybe even people didn't even look at, right? I think that helped, right? And I think as, somebody learns something in one shop, they move on, that information kind of diffuses throughout the industry. And I also think because we're traders and we talk with each other, I have a theory that we're all on the same side. We're all just insurance agents, right? Trying to be actuarials. Where do we warehouse risk getting long? Where do we warehouse getting short? We generally share information. I'm never competing for a trade, right? The market is giant, right? The producers sell about 1 million and some change lots every
I mean, you're
year.
showing that right now, right? You're sharing information
Yeah.
like to what some people would say are all your competitors, but that's not how you see it.
I don't think I'm competing them with a trade, right? Like I think we're actuarials, and so tech has gotten better. Some of the things that that I did or that I looked at are now in SynMax for sale for anybody who wants to do it because, my fund is small, it's risky, and some of the things I was building to understand the market, it was like, it needs more than one customer, right? Like I can't monetize it enough in order to extract a return, right? Like I need to chop this up, right, for other people. And so, we didn't have satellites back in the day. We didn't have access to satellites, right? The drone technology with thermal cameras, we didn't have access to that. Pipe scrapes, getting computers to like AI, and now everybody knows Python, so they can like draw these things in together and compile them. And so I think that has made the industry a lot smarter and the information diffused.
So maturation came from basically the dissemination of information about how to trade gas. Do you agree, John?
100%. Yeah, I think whenever I started my hedge fund in 2002, and the question was, I think I could replicate 95% of the information flow that Enron had, and you could do that because all the things that Bill talked about, like this information was out there, but many people in the industry back in 2002 didn't know where to find it, how to process it, what was important, how to use it in a productive manner, and build models, and like have all those skill sets. There were kind of industry players that did, but there was varying levels of sophistication in the industry. Enron did it very well, and it was kind of easy if you're coming out of there to take kind of the same process and the same knowledge. Right? Where do I even go to do the pipe scrapes? Like not everybody knew that back in 2002.
Yeah.
Right? And you certainly didn't have these third-party data providers to do it. And so my thesis was, let's invest a lot into fundamental information, and in the same way that Enron's strategy was. And by the way, a lot of the competitors who had this information back in 2002 were falling like dominoes, kind of post-Enron bankruptcy. And so, we started out, and we were at a competitive information edge as a startup vis-a-vis most of the industry. Yeah. And I think there was a time when that became a flywheel, that as we got more assets, more management fees, we could invest more, build up a bigger fundamentals group, and we could be more successful, and then got more assets, right? And so we were kind of always at this competitive advantage. And today, I think because of the third-party shops that are offering a lot of this, and that information gets disseminated over time as people leave, and like, hey, my previous employer was doing X, Y, and Z, we should do it here, right? Yeah. Then like the whole industry gets smarter and smarter over time, and the amount of time you have when you get an information advantage or you find something, the amount of time you have to exploit that before kind of everybody's doing that is very short today.
Yeah, I like to I think in the early days, I think at the end of the day, the hedger provided most of the value, but there were also other shops that had capital that was misallocated, and they were a customer too. Now, I don't think like a Citadel is a customer, except for like we don't want this risk in our book. I think we're all just warehousing the risk, right?
Yeah, from the physical participants in the market.
Yeah, I don't think I'm getting any edge off of any of these guys in this room.
Yeah, right? Too much information dissemination. So the headline is that you believe it was a gradual maturation of the market based on just more information and people getting smarter and sharing it with each other. I have an alternative theory I want to ask you about, okay, which I happen to like, and it comes from a book I read a long time ago called Hedgehogs, and if you haven't read it, it's fantastic. No doubt the author took a lot of liberties in telling the incredible story of Centaurus versus Amaranth, right? But the narrative of the story basically is that Brian Hunter was the Wild West version of the natural gas market. Centaurus, right, was the more mature, information-based, fundamental version of the market. And the showdown in 2006 was the turning point when everybody recognized the gas had grown up. I mean, do you agree with that? And are you comfortable talking about, inside baseball on how that all went down?
One of the liberties in that book was he presented it as Centaurus versus Amaranth. And really, it was Amaranth versus the market. And we had a piece of the other side. We had maybe a third of the other side. and the other 2/3 was syndicated across the market. His play is kind of best I've been able to recreate it, and I kind of, figured it out at the time. Just reverse psychology. He made a lot of money in '05 when Katrina hit, and at the time, gas market was very subject to exogenous shocks of hurricanes, and he did very well in '05. Had his risk limits go way up because of that. Wanted to play kind of a similar strategy in '06, kind of put on this huge position of getting ready for the hurricane scare. And I think he didn't necessarily need the hurricane to actually hit and cause damage, but he thought at some point there'll be a hurricane scare, and whenever that happens, I'm the only guy, Amaranth, am the only guy with this position, and I own all the hurricane insurance, and people are going to have to pay me to take it off my hands. I think the lesson there was nobody's bigger than the market. Right? And one of the great things about the natural gas industry is because you have this physical storage component to it, it has to balance twice a year. It has to balance coming out of the withdrawal season and going into the withdrawal season. It can get really funky between now and then, but that's a limited time. Like equities can stay mispriced for the very long term. You can see other physical commodities that have low barriers to storage stay mispriced for the long term. But gas has to go back to its fundamental value. And he kind of blew this spread out, and in order to support it, he had to keep buying more, buy more, buy more. And he wasn't bigger than the market. It ended up collapsing on himself.
It's a fair enough assessment. Bill, you were at Centaurus at the time?
Yeah, I felt like, he had a theory, and the reflexive principle got him. I don't think he thought about how much it cost him to get in, and if he was just mildly wrong, how much it would cost him to get out, right? And I even underestimated, because I had a lot. Within Centaurus, I had a lot of that on. I was getting run over daily. And, John calls me middle of the night, where would you buy, 30, 40,000 March April's for X year? Do you remember that conversation?
Yeah.
Or 60? It was some ungodly number.
I think it was
It was going to take me from being short to being long. And I was like, here. And we didn't get it. But then in the morning, I get a call from a broker from a bank that got it. Where's your bid on this? And I was like, I bid X. Hit my bid. John later was like, you bid what? You got it. And then he was like, how'd you make so much money day trading? Because he just had to get out, right? It was a process blowing up. And so, a couple years later, there was a shock, like a winter shock or something. I was like, holy shit, thank God that didn't happen, when I had the short position on, because maybe he would have got us all. But the reflexive principle is, I think, was what got him, is like it was costing him, hundreds of millions, if not billions, to get
billions, yeah,
into that position, and he had to be right. Yeah. And he was an underdog to be right, and so that just unfolded.
We only have time for one more question. I want to make sure we leave enough for the Q&A. I was going through my list here trying to pick my favorite one. Too many to pick from, but I think I'm going to go with, since we were kind of on the topic already, right? We just talked about what I imagine was your most successful trade, right? Most successful trade at Centaurus. Tell me about your biggest losing trade, right? It happens to everybody. Bill, you touched on this earlier with your thoughts on the psychology and how you have to remain stoic, and it's how you perform in the losing trades that sets you up for the winning trades. But let's counterbalance the story with some of the bad times.
You want to start me?
You start.
Okay.
I got to think about it. There's so many bad trades.
So we had 2 times at Centaurus when we were down 20-something% intra-month. I think they were both in December. I always found like December was the hardest time, because there would be that initial cold front would come through, and people could extrapolate and say, like, if it stays cold for 2 months,
look at how cold the whole winter is. Yeah.
And there was enough of an unknown to where, that could happen, right? And you had to keep that as a risk. And I think, this is going back to what Bill was talking about, being stoic, being able to separate from emotions, the fear and greed, how that drives markets, of keeping the process the same. Now, keeping the process the same doesn't mean you trade the same when you're up 20% as when you're down 20%. You trade differently, but you don't let the fear, dictate the process. Right? You step back and say, like, okay, here's where we are. This is what the situation is. Like, what do we think about the trade today? Including the fact that we're down 25% intra-month. One of the things I think that was a benefit to Centaurus was, I set the risk parameters about how I wanted my money to be managed. I was 25% of the fund on day one, and that built up over time. And so it was always, how do I want my money to be managed? And when I was 27 years old and single, I wanted that money to be managed fairly risky, but I recognized that kind of 1 out of 20 or 30 years, if you're running that type of risk strategy, you're going to blow up, and it's going to be game over. So in the meantime, as we're making money, let's force distributions back to investors and make sure that they get all their money back and multiples of their money back over time, such that if that scenario ever happens, that they'll say, that was a good run, and won't sue me. Right? And, as the fund got more successful, as I became wealthier and my personal circumstances changed, our level of risk, also changed. We became a less risky fund and had more capital behind us. But I think that, those times of, being down mid-20s and saying, like, okay, what's the right way to manage from here, rather than getting tapped by our investors, which were our boss at the time, and saying, you got to get out, I think had real value.
Bill, what's your take? And then we got to go into the Q&A.
Wow, I've had so many scary events. But I think generally, if we went for earlier, it was always some version of the winner. I think our structural job was to, warehouse ratable contracts and sell to the permalength in the winter and insure against the winter. And, if it was a bad month, it would be, like John said, early winter cold shot, and it was going on. I think in terms of dollar amount, you don't see it because we were up so much money as when Freeport blew up. I mean, that day was like, oh, my God. It was a lot of money in intramonth. And I think, I think most of my career, it's like, oh, my job is to be short. And I think, now I'd say just recent longs. It's just like the way the market has changed, where the producer was just like, we produce no matter what. And we'd be like, why don't they just delay, and the shape of the curve, they can make a return, et cetera. That didn't happen. And I think it was because the incentives, both externally and internally, the stock market just rewarded production back in the day. And nobody was getting paid to, optimize, when they produce gas. The technology, they didn't have SCADA systems, et cetera, going on, so they can turn them off quickly. Yeah. And just kind of the human resources, like who's going to be thinking of this? And now they have that. And now it's like, oh, it's a little bit more dangerous because the producer's not just this guy, it's like the widget runs full stop no matter what until we have to shut off. It's like now they're traders. And so I think now the issue that got me is we're here and it's going to go to $1.25. Nope. They see the shape of the curve is 25%. They're going to cut off gas. It's going to rip you. And so those types of trades are happening without those kinds of moves are happening without the winter shock, And also on the flip side, you're having collapses, in pricing, rigs are coming back in. So it's a different market with different information. Now I have to really pay attention to producer behavior instead of looking at a report in a quarter. Okay, they're going to produce this, and they always overperform. Yeah,
one of the characteristics of the market is producers always sell the strip, right? And so somebody's got to provide liquidity for that. A dynamic that was very strong in the 2000s and then into the 2010s, it's largely changed today, is you had the commodity index guys who were the longs, who would be concentrated in month one or month two. And so the speculative community had to take the other side of this trade of being short the front and long the back. not everybody was doing that, but in aggregate, the spec community,
It had to balance.
it's a zero-sum game with regards to speculative contracts, and so that was where the risk was that because the specs kind of broadly had that position on of short the front, long the back, whenever you'd have these spikes in the front, there wasn't natural liquidity provider. Right? And so then you just get guys stopping out. You'd get the momentum black box guys who would be buying into that, and so the moves up would just get super exaggerated.
Just destructive.
Yeah.
I think Gerald once told me liquidity always exists at a price. So it was there, but you had to take it pretty high to find it.
I mean, we had. Yeah.
Okay.
Yeah, we had that again. Like, like the market has to get crazy enough that like macro strats and people who normally don't even look at natural gas go, crisis, let me stop in, And so one of those times I even called you, John, where are you on 20,000 March Aprils? I think it was when auctionsellers.com blew up, right? Like, and it just kind of distorted it, and you need to find the macro strats to provide liquidity. Yep. I was like, I know a macro strat.
All right, we got to get to questions.
Okay, so my question is, I'm going to challenge your term of the gas market has matured. I'd say it's evolved. And the reason why I'm saying that is because maturity implies we've hit some steady state now and things are going to stay the same. I'd argue that we're actually going to revisit the volatility of the 90s, early 2000s. Why? LNG is a game changer. Power demand is a game changer. We haven't built any appreciable amount of storage, physical storage in this country for 2 decades, right, Bill? I mean, it's forever. Renewables, although they're great, have introduced a lot of intermittency. So the variability, and by the way, we saw this 2 or 3 years ago, right? Two relatively warm winters in a row kind of maybe tamed that a little bit, but we certainly saw it in Europe, and we've seen bits of it here. I think we're re-entering kind of the new golden era for different reasons. Do you agree with that, disagree with that in terms of the envelope of prices?
When I talk maturity, I think it's in terms of the information disbursement, not necessarily terms of like how infrastructure is playing out and how volatility is going to play out. So I think that most of the trading shops are well educated on the drivers. They have access to certain tools, and it's getting better and better tools and sharpening those knives. In terms of like the volatility, I definitely agree that the brakes of natural gas, which is storage, has not grown as the infrastructure has grown, right? Like we've gone from 70 Bs to 106 Bs, and storage hasn't done anything. And on top of that, we have a lot of supply being built for this LNG export facility, right? But what happens when they don't want the gas, right? Like the world is kind of relying on the U.S. as like the sinkhole. Maybe there's some demand switching along the way internationally, but we have on our charts, everybody thinks like the utilization rate of these storage facilities is going to be what we've seen historically, and I'm like, I don't know. I don't know. Like, China and Southeast Asia, they have, other ways to deliver power. They build more nukes in a year than,
Yeah. It sounds like you agree with his comment, though, that we could be entering a golden age of natural gas trading.
I think it's a golden age of volatility is coming, but I'm just saying, like, the information, like, everybody understands this LNG. When I talk about LNG, people, there's nobody scratching their head about, I'm slightly concerned about LNG utilization rates as well, right? When we're talking about supply and where it's coming from and how people are affecting, everybody's got access to the satellite data and they're tracking it too. And so, in our days, and John, I think it was like knowing what's going on now was like a few people knew what was going on now, like could correctly assess what's going on now. And then there was the added of, and this could happen in the future, which is what I would be back then. That was my personality. Like, what if this goes wrong? And I think now we have a lot of people who know what's kind of going on now within region, half a B a day, and we're all thinking creatively or like the what if scenario analysis in the future. And so that's where I think it's mature, right? Like I think a lot of people know what the hell's going on now within, half a B. And the market will get volatile, but we're trying to figure out like what happens, the what if scenario. John?
I agree with the premise, or some of the premise. I think one thing that's provided kind of more flexibility in the market is that producers have gotten more sophisticated as to how they manage their assets. And back in the 2000s, they were kind of robots. In November, December, they would figure out what their CapEx schedule was for the next year. They would do a bunch of hedging, and they were kind of just on that process, right? And to make a decision in response to prices, number one, they were slow to make that decision. Number two, because of the nature of the assets back then, the conventional assets, it was slow to change production. And then in the 2010s, you saw, the Chesapeake start to try to do stuff with, whenever prices got very low, they would shut in, and they were kind of this crazy, cowboy in the industry to actually shut in production at very low numbers. Everybody else was like, we're 70% hedged. Forget about opportunity costs. We could take off our hedges. That was too complicated. Producers are sophisticated today, right? And so, not only does the nature of the assets, with unconventional assets, lead to very different ability to either take supply lower or higher in the medium term, like in the 6-month period, that didn't exist previously, but they're just also much quicker to do so, right? And so I do think you will see supply acting as a shock absorber that didn't used to exist in the past.
Agree with that.
Promotional plug, SynMax, detail tracking. Throwing that
Rig
out there.
tracking.
All right, let's get another question from the audience. We got one right here up front.
John, on the board of Meta, and we're talking about hedge behavior, and it used to be the producer selling the strip. Do they feel like they're short gas in the back? Are you talking with them about hedging? Are we going to see a new participant enter the market that requires people to sell insurance?
In terms of Meta's CapEx, the cost of energy is still such a small component of it. I haven't discussed this with them directly about kind of what their long-term hedging strategy is, but I just don't think it's hit their radar. I think they're pretty ambivalent to it, and just it's a rounding error.
A hyperscaler will gladly pay you $160 a megawatt round the clock, right, and not blink an eye for an AI facility, right? The power traders in the room probably like, holy shit, or are already aware of that, right? And so, it's the value. It's this much compared to that. But I think if we start, I don't think we're going to get $100, $200, $300 prices or European prices in power where they're thinking, oh, we need to hedge.
Yeah. And even that deal, I assume you're talking about the nuke transaction announced last week, right? And a lot of that was the hyperscalers are less concerned about price. They're concerned about, can you deliver me a bunch of megawatts in one location in the near term? You tell me the price that it's going to take to do that. And in this case, it required a fixed price contract at a very high cost per megawatt hour. And so you can give me 2 gigawatts in one location, I will take it. That is, again, the cost of electricity is secondary and is, a relatively small percentage of total cost of data centers. And so that's what they're focused on.
What is the limiting factor then? If they're price insensitive, what do they care about when positioning these? Is it access to internet? Is it cheap land value?
You got to be on a broadband corridor. You need a lot of land. You want to be close to some urban center where they can recruit people to live. They need not a big workforce, but you still have to convince some engineers to move out there, and you need power in one location.
Interesting. All right, any other questions?
Does clean energy matter anymore? It seems like as the data centers are gobbling up energy, it feels like it's an afterthought. It used to be 5 years ago, must be clean, must be solar, must be wind. Does it matter anymore?
First priority is to get access to electrons, right? And that is the number one priority, bar none. I think you also see different hyperscalers prioritize their commitments to net zero differently. and I won't name names, but there are some that are kind of to where this is high priority for them. There are some for which they want to kind of be in the pack. And then I think there's also, one of the big questions that I think will get answered this year is how the greenhouse gas protocol comes about. And so, historically, it's been okay for you to open up a data center in the Northeast and buy Texas RECs and call that as net zero. There's proposals to kind of make the region not the United States, but make it kind of more geographic regions within the United States, such that if a corporation wants to be called net zero in the future, they have to link up Northeast data center with Northeast RECs, which obviously are, can be 100x the cost of a Texas REC. And so those rules are being debated now. It'll be interesting to see how they come out. I think they're supposed to come out this year. And it'll be interesting to see how the hyperscalers react to that.
Go ahead. Last question. For John. How would you say, you said something to me the other day when we were at lunch, and I was like, holy shit, this is pretty scary. I said, do you want to trade? He goes, natural gas is a lot harder now. How would you quantify that relative basis? Like, if you can give kind of, is it 5 times harder, twice as hard? Like, what would you say?
Yeah, look, I'm pretty far out of it now. I'm like the guy that you said, who once a year, if I see that the industry needs a new capital source,
right,
and that the markets are disjointed enough from fundamentals that they need a new capital source, and it's kind of clear to me that they do, and that's what's getting priced into it, then I'll come in. I think my fear in the market today is that it used to be enough to model the supply and demand on a national basis, and that there was enough slack in the system of moving gas around to where you wouldn't have a big price disconnects east of the Rockies, right? And I more and more fear that that I, as an outsider now to the game, will get caught in a trap where the national supply demand is showing one picture, but Henry Hub supply demand is its own micro market that I don't have comprehension of.
Gotcha. Okay.
All right, that is unfortunately all the time we have for our panelists. Really appreciate you guys coming out. Let's give it up for Bill and John.
Yeah.
Thank you.
Thanks.